Hello and welcome to this Commerzbank webcast. China spent many years building up its foreign currency reserves, but this changed in the middle of last year. Since then, the People's Bank of China has sold foreign currency to the tune of $436 billion in order to shore up its currency. The bank is having to support the yuan because the Chinese are moving their money abroad, for example to invest in Western real estate. This outflow of capital is eating up more foreign currency than China is taking in via its large trade surplus. Normally this shortfall would cause the yuan to plummet if the People's Bank did not sell off US and European government bonds and use the foreign currency raised to support their own currency. Instead of sacrificing foreign currency reserves, China could also place limits on capital exports in order to stabilize the yuan. But then China's savings would be virtually frozen, and the PBoC would, as in former years, have to reinvest the excess dollars from the trade surplus in treasuries, which earn only little interest. In addition, China would have to admit, in returning to strict capital controls, that unlike the US, China is not yet an attractive investment location. For the foreseeable future, the Chinese government can be expected to absorb the impact of the private sector moving capital abroad largely by foreign currency reserve sales, rather than reversing the relaxation of capital movement of recent years. However, supporting the yuan via the sales of FX reserve means that the PBoC will continue to sell both US and European government bonds. In itself, this weighs on government bond prices, of course. Yet overall, Western capital markets still benefit from China investing its large current account surplus abroad. The only contrast with earlier situation is that private individuals in China will be investing less in Western government bonds and more in other assets than the FX managers of the PBoC. Thanks for listening, and I hope you enjoy reading Week in Focus.